There's a conversation I keep hearing, at dinner tables, in comment sections, in the break room at work, and it goes something like this. The stock market? That's just gambling. You're just betting on numbers going up or down. It's a casino. The house always wins. And the person saying it usually isn't cynical by nature. They're not uninformed about everything. A lot of them are smart, careful, thoughtful people who watch someone they know lose money in the market. Or they lived through 2008. Or they just have a deep, reasonable distrust of anything that feels like it could vanish overnight. And here's what I want to say first, before anything else. That distrust is not stupid. It is not uneducated. It comes from real pain, real experience, and a financial system that has, at many points in history, genuinely hurt people who weren't given the full picture. But the conclusion it leads to, that investing in the stock market is the same as sitting down at a blackjack table, that conclusion is costing people something real, something quiet and cumulative and invisible. And I think it deserves a real, honest answer. Not a sales pitch, not a lecture, just the truth about what these two things actually are, and what the difference actually means for your financial life. Hi, my name is Alpha, and in this video, we're going to take that belief seriously, not dismiss it, not mock it, and look at it clearly. Because I think when you understand what actually separates investing from gambling, at a structural level, something shifts, and that shift matters. Let's get into it. Here's why this comparison feels so convincing on the surface. Both involve money going in with an uncertain outcome. Both can result in loss. Both can result in gain. Both have an element of unpredictability that no one, not the smartest analyst, not the most sophisticated algorithm, can fully eliminate. And both, at their worst, can become psychologically addictive in ways that are genuinely destructive. So the surface-level similarity is real. I'm not going to pretend it isn't. But similarity on the surface and similarity in structure are two very different things. And the structural differences between gambling and long-term investing are so significant, so fundamental, that treating them as equivalent is a little like saying that swimming and drowning are the same thing, because both involve being in water. The confusion also gets reinforced by the way financial media works. When you watch business news, it's fast, it's urgent, prices flash, tickers scroll. Someone is always shouting about what to buy and what to sell, and why today is a pivotal moment. That presentation, that energy, looks and feels very much like the energy of a casino floor. Everything is charged. Everything feels like a bet. But that's the media's relationship with the market. It doesn't have to be yours. Let me start with what gambling actually is, structurally. In a casino, or in a lottery, or in sports betting, the game is designed so that over time, the house wins. Not every hand, not every spin, not every ticket. But over enough rounds, the math is built into the structure of the game to ensure that the provider of the game takes in more than they pay out. The expected value, which is the mathematical average outcome of playing over time, is negative for the player, always. That's not a flaw in the system, that's the system. A casino that didn't have a built-in mathematical edge would go bankrupt. The entire business model depends on participants losing, in aggregate, more than they win. When you sit down at a roulette table, you are not buying anything. You are not acquiring ownership of anything. You are placing a bet on a random event. And when the spin is over, whatever was in your possession before the spin is either gone or multiplied. But the underlying asset, if you can even call it that, had no intrinsic value to begin with. The chip has no earnings. It produces nothing. It serves no function outside of the game itself. Now let's look at what a stock actually is. When you buy a share of stock, you are buying a small ownership stake in a real company. A company that makes things, or provides services, or generates revenue, or employs people, or holds assets with genuine value. You are not betting on a number going up. You are becoming a partial owner of a functioning economic entity. And here's why that distinction matters in a way that's more than just semantic. Over time, the economy, in aggregate, tends to grow. Companies tend to generate more revenue than they cost to run. They produce profits. Those profits either get paid out to shareholders as dividends, or they get reinvested into the business to generate more future growth, which increases the value of the ownership stake you hold. The expected value of owning a diversified piece of a growing economy over a long enough time horizon has historically been positive. Not guaranteed, not without volatility, not without years where things go sharply down, but structurally positive in a way that the expected value of gambling never is. The S&P 500, which is a broad index of 500 large American companies, has averaged a return of roughly 9 to 10% annually over the past 100-plus years, including every crash, every recession, every world war, every financial crisis. That average includes 2008, when the market fell nearly 50%. It includes the dot-com collapse. It includes the COVID crash of 2020. Through all of it, the long-term average held. A casino does not have a long-term average return for the player. It has a long-term average loss. That is the foundational structural difference, and it changes everything about how these two activities should be understood. Now, and this is important, there is a version of stock market participation that does look a lot like gambling. And I want to name it clearly because I think conflating it with long-term investing is part of what creates the confusion. Day trading, buying and selling stocks within a single day or over very short windows, trying to time the exact movement of prices, has an expected outcome that looks much more like gambling than investing. Studies consistently show that the vast majority of individual day traders lose money over time. A Stanford and Berkeley research review found that less than 1% of day traders were consistently profitable over a multi-year period. The rest lost money, often significant amounts. Why? Because in the short term, stock price movements are extremely difficult to predict. They respond to news, to emotion, to algorithm-driven trading patterns, to macroeconomic signals that even professional investors with enormous research teams regularly misread. In the short term, the signal is buried under enormous noise. Trying to trade on short-term noise is genuinely close to gambling, not because of the stock market itself, but because of the time horizon and strategy. Buying a diversified index fund and holding it for 30 years is the opposite activity. It is patient, intentional ownership of a broad piece of the economy. It does not require you to predict which company will win. It does not require timing. It requires only staying invested long enough for the underlying growth of the economy to work its way through the noise. There's also a psychological layer to this that I think gets missed. The feeling of investing, when the market drops and the number in your account gets smaller, activates the same emotional response as losing a bet. The brain does not easily distinguish between unrealized paper losses and actual money gone. The anxiety, the urge to do something, the desire to cut the loss before it gets worse. These feelings are real, and they are powerful. And acting on those feelings, selling when the market drops, pulling out and waiting for a better time to get back in, that is the behavior that turns investing into something that produces bad outcomes. Not because the market failed you, but because human psychology, in that moment, made a short-term decision in the middle of a long-term story. This is why the comparison to gambling persists, even among people who have technically been invested. Because they experienced the emotional roller coaster, made an emotionally driven decision at the worst possible moment, and walked away with less than they put in. And they're not wrong that something went badly, but the culprit wasn't the nature of investing. It was the combination of short-term thinking and long-term tools. Research from Dalbar, a financial services research firm, has tracked this pattern for decades. Their annual study consistently shows that the average investor earns meaningfully less than the market return over long periods. Not because the market didn't return that amount, but because investors moved in and out at the wrong times, driven by fear and optimism in alternating waves, and missed the best days in the market by being on the sidelines. Missing just the 10 best trading days in a 20-year period cuts your return nearly in half. 10 days, out of more than 5,000, and those 10 days almost always happen during or just after periods of extreme fear, exactly when most people are tempted to be out of the market. This is not a story about the market being rigged. It's a story about the cost of letting emotions drive long-term decisions. Here's the reframe that I think changes how you hold all of this. Gambling is a zero-sum game. For someone to win, someone else has to lose. The casino doesn't create value, it redistributes it, with the house taking a cut. If everyone stopped gambling tomorrow, nothing productive would have been lost from the economy. Investing is the opposite of that. When you invest in a company, you are providing capital that allows that company to hire people, build products, serve customers, and generate returns. The company creates something real. The value does not come from someone else losing. It comes from economic activity, from the actual output of human effort and innovation and problem solving. The stock market, at its core, is a mechanism for connecting people who have capital with people who need capital to build things. That mechanism is imperfect. It is sometimes irrational. It is shaped by human psychology in ways that create volatility and inefficiency. But it is not a casino. It is not designed for you to lose. The mindset shift is this. Stop thinking about the market as a place where you bet on prices. Start thinking about it as a place where you become a partial owner of real businesses that are trying to generate real value over real time. When you frame it that way, the daily price movements become what they actually are, noise in a much longer story. And the long-term trend of that story, historically, has been growth. So what does this mean practically? What does investing that doesn't feel like gambling actually look like? It starts with diversification and time horizon, two concepts that, together, do more to remove the gambling quality from investing than anything else. Diversification means not betting on a single company or a single sector. It means owning a broad slice of the market through something like a total market index fund or an S&P 500 index fund, so that no single company's failure can wipe out your position. When you own 500 companies, the failure of one is a rounding error. When you own 5, it's a crisis. Time horizon means giving the investment enough time to let the long-term trend overcome the short-term noise. The shorter your time horizon, the more stock market investing resembles gambling, because in any given year or even any given 5-year window, outcomes can be negative. But over 15 or 20 years, the historical probability of a positive return from a diversified index fund has been very high, not certain. High. If you have money you'll need in 2 years, the stock market is the wrong place for it. Put it somewhere stable. But money you genuinely won't need for a decade or more, that money, sitting in a savings account earning less than inflation, is quietly losing purchasing power every year. And the fear of the market that keeps it there is not protecting you, it's costing you. Automate your contributions so that you invest consistently, in good months and bad, without requiring an emotional decision each time. This approach, called dollar cost averaging, means you buy more shares when prices are low and fewer when prices are high, naturally. It removes the temptation to time the market because you're not timing anything, you're just steady. And find a fee structure that doesn't eat your returns. Low-cost index funds, with expense ratios under 0.2%, exist specifically to give ordinary investors access to market returns without paying for active management that, statistically, does not outperform the index consistently over time. I want to end where we began, with that person at the dinner table who says the stock market is gambling. That belief protects something. It protects against the fear of loss, against the vulnerability of committing money to something uncertain, against the feeling of being taken advantage of by a system that has, in real and documented ways, failed regular people at various points in history. That protective instinct deserves respect, not dismissal, but protection from the wrong thing can leave you exposed to something worse. And the quiet, compounding cost of keeping money out of the market over a lifetime, of watching inflation erode its value while fear keeps it on the sidelines, is a loss too. Just a slower one that doesn't feel dramatic enough to name. The market is not a guarantee. It is not without risk, but it is also not a casino. And the difference between those two things, understood clearly and acted on with patience and intention, is one of the most practically important financial truths available to anyone willing to sit with it. You don't have to go all in. You don't have to become a stock picker or spend hours analyzing quarterly earnings. You just have to start, small, diversified, consistent, and patient. And let time do what it has always done for the people who stayed in the room long enough to let it work. That's not gambling. That's the opposite of gambling. And if this video gave you a clearer way to think about that, if it answered something you've been sitting with, please don't forget to like this video and subscribe to the channel. It's genuinely how more people find their way to content like this. And that's exactly why we keep making it.